Our presenter again is Dr. Kelly Lange in our Department of Ag and Applied Economics. So take it away, Kelly.
All right, thank you, Tracy. I'm glad to get to speak again today. The personal financial management stuff is something I'm pretty passionate about, so I probably get more excited than I should about something that is probably not that exciting to most people, but in my opinion, it's incredibly important, and it's one of these things that you can actually work on and improve, and so that's kind of nice. So my topic today is going to be over saving strategies and credit management, and these two topics go together really well. They may not seem like it initially, but they really are very integral with each other. So kind of as a brief introduction here, just to mention a few things. So it is a lot easier to spend money than it is to save. And this just kind of goes back to a human nature kind of thing. When we want something, we tend to want it right now. We don't want to have to wait for it. So there is this kind of an itchiness to us that whenever we want something, man, we want it now. And so we might ought to save that money, but like, well, I'd really like to have this, so I'm going to go ahead and buy it. And so you don't save as much as you should. So saving is very much a conscious action. You have to think about it. You have to plan. Saving doesn't just miraculously happen. And this is the problem that a lot of people have when it comes to saving is they think, well, maybe it'll just happen. It doesn't. Credit is a good tool in some cases, but you have to be extremely, extremely careful with it. Above all else, when you are borrowing money, you do not want to borrow more than you can realistically repay. And we'll talk more about this a little bit later on in the presentation. So as I mentioned, saving and credit management go hand in hand because the better you are at saving, the less you are ultimately going to have to rely on borrowing. And the cool thing about saving is if you're not very good at it, you can improve at it. So why save? There's actually a lot of reasons why you would want to save. This is not an all-inclusive list, but these are some of the high points. First and foremost, in the kind of immediate term, if you've got some savings, it provides a short-term source of liquidity or cash. So, if you've got some money that you've saved up and you need to grab a little bit of cash, you're going out of town for the weekend or something like that, you've got that because you've saved up some of that money. We'll talk about it a little bit more here in just a minute, but saving for an emergency fund is crucial, and we are in a great time and example of why you need to have an emergency fund. So we'll talk more about that in just a second. Saving up for future purchases, and a lot of times those future purchases are quite large or large expenses in the future, is another good reason to save. So a couple of the things that people tend to think about most when they think about saving for bigger purchases are cars and homes. Those are kind of the standards that we tend to think about that you would want to save up for. Something that a lot of times people don't think as much about until it's like the moment comes where it's like, oh, I think I need these things, are things like appliances and furniture. So these are items that obviously that's not going to be as expensive as buying a car or a house, but they're pretty pricey. It's not something you just typically just run out and buy. It's something you're probably going to do a little bit of research on, figure out exactly what you want. You're going to do some comparison shopping and things like that. Well, if you have kind of prepared for those things and you've saved up in advance for that, it saves you the problem of whenever you get to the store and you're ready to buy, a new refrigerator or a new couch or something like that, and you've got the salesperson there going, well, hey, we offer this in-store financing. Well, if you've saved up for those purchases, you can go, no, thanks, I don't need your financing, because in-store financing is often actually quite expensive. The interest rates that are charged on some of that can be kind of ridiculous, actually. So if you'll plan ahead just a little bit, save up that cash ahead of time, you don't have to worry about the pressure of in-store financing. Technological things like TVs and computers and phones and stuff like that would also fall into this category. Not humongous purchases, but they're big enough that you're going to kind of stop and do your research and try to save up for some of that stuff. Also things like children's education, weddings. These are things people tend not to think about in the immediate term because they're like, well, that's a long way off. That's a long way in the future. But the time to start saving for your child's education is when they are a baby. And the reason for that is because if you will save a little over time, you don't have to save as much at one particular time, and you can invest that somewhere where it can hopefully earn some interest or generate some dividends, something like that, so that you can put little bits away at a time and have a pretty nice large sum come time you actually need to use it. With a little bit of planning, you can make that a much less stressful process than whenever, say, your kid is about to graduate from college or graduate from high school and you're like, oh my gosh, how am I going to pay for college? Weddings are the same thing. Weddings can be very expensive. It's something that people don't tend to think about until it's like imminent. It's right here. But if you plan in advance for that stuff, you can make it a lot less painful. And another thing that people tend to not think about as far as saving for in advance are things like travel and vacations. And what usually happens, you want to get away, you're planning to do some travel, something like that. Well, you end up, in a lot of cases, you put all those expenses on your credit card. Okay, not a problem if you pay your credit card off every month. However, if you don't, well, you might find that by the time it's all said and done, you might pay for that vacation a couple, 3 times because of interest that is accruing if you put that on your credit card or something like that. So those are just some examples of those kind of future purchases that often can be anywhere from sort of medium large to really large, like a house, that you would want to save for. Also, saving up to pay off major debt. So this might be things like saving up to pay off your vehicle or pay off your home, and maybe you want to pay those things off early. Well, you need to be able to save up to do that in the future. This could also fall in the category of if you get into credit card trouble, save up to be able to pay off credit card debt. These last 2 topics down here kind of go together in a lot of cases. You can save for investment. In a lot of cases, that investment is going to go toward like your retirement funding as well. But saving up money so that maybe you want to put that money into stocks or bonds or mutual funds, money market accounts, a CD, something like that. You need to be able to save to put that money into those investments, and you need to be able to save enough over time that it will have enough time to grow into something substantial. So those are just a handful of reasons why you want to save. There's lots of other good reasons to save as well, but these tend to be kind of the big reasons for a lot of folks. All right, so on an emergency fund, cannot stress it enough. You need an emergency fund. Emergency funds are used to help you plan for the unexpected. And I can't think of a better example than the year 2020 for unexpected events. Nobody back in January of this year expected what we have seen happen this year. So an emergency fund is used for things like unexpected bills, okay? That could be anything from unexpected illness or injury to your car breaks down and you've got to pay $3,000 for a new transmission or something like that. So that's what your emergency fund is going to help you with, is those unexpected bills, the unfortunate situation of job loss. And we are in a situation right now where a lot of people have experienced this. Unexpected illness, injury, or maybe unexpected death of a spouse or something like that. Market downturns, recessions. I put in here global pandemics because we are seeing things that have happened from an economic standpoint this year that nobody would have ever guessed might have occurred. So an emergency fund is to help you plan and weather the storm when those unexpected events come up. They can be small unexpected events, they can be huge unexpected events. But the one thing that is certain is at some point, you don't know when, you don't know what, but something is going to happen. So an ideal emergency fund is you should aim to have enough liquidity, enough cash on hand to cover 3 to 6 months worth of your typical living expenses. There's probably not much out there that would be more stressful than to get into a situation where maybe you lose your job unexpectedly and then all of a sudden you realize, I don't have any cash. I don't know how I'm going to pay for my expenses. What happens in those situations is a lot of times people turn to credit cards. Then that can start a credit card spiral with interest charges that then makes it really difficult to get out of that credit card debt. So aim to have enough liquidity to cover 3 to 6 months of your typical living expenses. That is a good emergency fund. It will give you a surprising amount of peace of mind to know you are prepared for something like that. So saving begins with a plan. So as I mentioned a few minutes ago, saving doesn't just happen. You absolutely have to have a plan to save. So to do that, you need to think about your financial goals and then develop a strategy of how do you plan to get there. And the way you do this is to build a budget, and the hard part is stick to your budget. So to develop a budget, first, look at your short and long-term spending priorities. So what are you wanting to do in the short term? Maybe it's establish your emergency fund. What are you wanting to do in the long term, say for retirement, for example? Then look at your past spending to determine what are your typical income and expenses each month. And then track your income and expenses and compare that to what you budgeted. You have to have a realistic budget. If your budget is not realistic, then you will not stick to it. And that becomes very discouraging. If you, every single month, if you put a budget together and that budget is just not realistic to what you actually spend, you're going to get discouraged. And if you blow that budget out of the water every single month, pretty quick, you're going to quit using it. So make your budget realistic, and then don't forget to adjust your budget as your life circumstances change. So if you get a new job, if you get a raise, if you lose your job, if you get married, if you have kids, adjust your budget as you need to and make it realistic. So when you're making your budget, you want to be careful that you don't end up with too much excess cash on hand. I mean, that's a nice problem to have, but you can get yourself into trouble with that. The more cash you have kind of sitting around, the more you're tempted to spend. If it's just sort of there and you're like, well, I've got all this cash, I'll go buy something. Well, you're probably going to buy something that you might not really need. And you could have taken that cash and put it to work for you, say in an investment somewhere. So instead, have a plan for what am I going to do with that excess cash when it's available. So one of the best principles to saving is the idea of you pay yourself first. So what happens is a lot of times people tend to think of savings as whatever you have left over after you've paid everything else. The problem with that strategy is very often there are no leftovers. Instead, what you ought to do is commit to try to pay yourself first. And so there are some strategies you can use to try to make this a little bit easier for yourself and maybe a little bit less painful. Have your savings automatically deducted from your paycheck. So when you get paid, you can, it's actually pretty easy. You can set up like a special savings account or maybe a separate checking account or something like that that's not your primary bank account. Have that savings go directly into that account. So if you set up a special savings account with your bank, you can go in and specify each month I want $200 or $500 or however much it is that you want that's going to go directly into that account. You don't ever see it in your regular bank account. Don't put your savings into your regular bank account because, one, it's a lot harder to miss it if it was never in there to begin with. So if you have that money from your paycheck, it goes into your bank account, and then you have to consciously move that yourself, it kind of hurts because you're like, man, I'm taking that money and I'm moving it out of here and I can't use it to spend with. Also, if it's in your bank account, the temptation to spend it is just too high. Like it's really hard to exercise that self-control when there's some new something or another that you want. You're like, man, I've got the money in my bank account to buy it. I really ought to save that, but I really want this thing right now. So if it's in there, the temptation to spend it is going to be way too high. So instead, get a dedicated account set up that's just for savings. And you don't have to have just one account. You could actually have a couple of different savings accounts. One that might be your specified emergency fund account. One might be your vacation account. So you can have certain accounts where you're able to funnel that money into a specific place. Ideally, try to pick a place to put that savings where it's going to generate you some interest. So whether that's a savings account with your bank that pays you a little bit of interest, maybe it's a certificate of deposit, maybe it's a money market fund. There's a lot of options out there for places that you can put that money so it's not just sitting there, it's actually working for you. It's generating some interest on itself. Okay, I'm going to shift over now and talk about credit and debt management because like I mentioned at the beginning, those go along with saving pretty close and you'll kind of see it all tie together at the end. So credit is convenient. Obviously, pretty much all of us have a credit card. However, if you do not use credit wisely, it is a terrible curse and it can literally ruin your life. So most people get into trouble with credit because they don't think about the interest charges associated with it. depending on the type of credit and your associated interest rate, if you don't pay attention to those interest rates and how that works and how it's calculated, you could actually end up paying for something several times just because of interest. So I'm going to kind of give you a little bit of a background of how credit works here. So credit allows you to make purchases now that you then have an obligation to pay later. A revolving line of credit, what we're most familiar with are credit cards, is credit that is extended to you prior to a purchase. And usually with a credit card, you've got some kind of predetermined limit that you could spend up to on that card. Spoiler alert, don't spend up to your credit limit. You don't want to do that if you can avoid it at all possible. Any unpaid balance plus your accrued interest is going to carry over to your next payment period. So what happens is the higher the balance you carry on a credit card, for example, the more interest that is going to accrue on that balance. Then you start having interest that's compounding on itself. That ultimately results in the higher the overall amount that you repay on that money you borrowed. So a little bit about interest rates here. So APR is the annual percentage rate, and that is the actual effective rate of interest on a loan. The APR very often actually includes several things. It'll include whatever the stated interest rate is. But if you've got a credit card, for example, that has additional fees or penalty fees or something like that, that might be added in to your APR, that is going to be part of that. APR is required by law to be disclosed in bold print. So most people don't look at their credit card contract whenever they apply for a credit card or whatnot. But you really, even though it's not the most exciting reading, but I really recommend go take a look at your credit card contract and read some of this stuff. It's kind of eye-opening to see what's in there. But by law, your APR has to be disclosed in bold print, and it has to specify all of the different components that make up that interest rate for that loan. Now, you can have a fixed or a variable interest rate. Fixed interest rates, in general, tend to be fixed for the life of a loan, particularly if we are talking about installment loans, and I'll talk about those more here in a few minutes. In some instances, like with a credit card, it may be a fixed interest rate, but with notice, your credit card company can actually change that interest rate. So you do kind of want to keep track of that stuff. And again, that's the kind of thing that's going to be specified in your credit card contract, how that would work. Variable interest rates are allowed to vary based on whatever market interest rates are doing. So in theory, you say, oh, okay, well, a variable interest rate could theoretically vary downward. Yeah, it could. The reality is they don't do that very often. In a lot of cases, variable interest rates tend to vary upward. The issue with variable interest rates, especially if you had a variable interest rate on like a long-term loan, like a mortgage, is those are really hard to budget for. A fixed interest rate, because it's generally fixed for the life of the loan, is pretty easy to budget for, and so you're not going to have any unexpected cash flow issues if all of a sudden your interest rate jumps up because market interest rates did. Many loans and credit cards have interest that compounds on itself, and that's where credit cards especially, you can just all of a sudden start this snowball effect where your interest is accruing on interest and your credit card debt can get out of control really quickly. Be very, very wary of low introductory rates, particularly on credit cards. So we all get these credit card offers in the mail that a lot of times on the envelope will have some low introductory rate or 0% APR or something. And if you read the fine print, what you find is that's your introductory teaser rate. They're trying to get you to apply for that credit card. And then if you look at the fine print after 3 months or 6 months or a year or something, all of a sudden that interest rate jumps up and it's not so good anymore. So be really careful of those teaser rates, because you can get yourself into a situation where if you're carrying a balance on that credit card, yeah, maybe initially you're not generating any interest, but at some point it's going to start generating a lot of interest. So to use credit cards in particular wisely, everybody should probably try to have one credit card. If nothing else, it is a safety net and it gives you a source of emergency funding if you didn't have an emergency fund through savings. But try not to have more than 3 credit cards. A kind of a scary statistic is that the average credit card user in the US has about 4 credit cards and they carry a balance on all of them. That's pretty scary. So they're paying interest on all of those credit cards. I mentioned earlier, on your credit card, you'll have a limit. Don't go out and max out your limit on your credit card. Try to average, generally, no more than 20 to 30% of your credit card limit. That will keep your spending in check, for one thing, and it also keeps your credit card balance to a point where hopefully you're able to pay it off, if not in full, very close to in full, every single month. So that leads into pay off as much possible on your credit card every single month. Ideally, in a perfect world, try to pay off the full balance every month. That will completely eliminate any interest charges. If you pay off your credit card balance entirely every single month, it doesn't matter what your interest rate is because you're never going to have to pay it. And that is the goal that people should try to have with a credit card, is you're essentially paying for items on your credit card, but you're paying for them in cash. You just have kind of the flexibility of having kind of that month to be able to get the cash together to pay that off. That is a whole lot better than putting that purchase on your credit card and then that balance carries over to the next month and the next month. And all that while you've got interest generating on that balance. That's how you start accidentally, you pay for things 3 or 4 times before you're able to actually pay that charge off. So if you'll pay off your credit card balance every single month, you don't ever have to worry about interest charges. And that's a really nice feeling. Credit cards are obviously convenient and they can be very useful if you use them wisely. But if you don't, they are an absolute nightmare. Misuse of credit cards and debt is the #1 reason for bankruptcy in the US. And the interest that accrues on an unpaid balance, particularly on your credit cards, will snowball quickly, and it can result in some credit card debt that can be very, very difficult to recover from. So I'm going to shift over a little bit and talk about consumer loans. So these are loans that are generally used for larger purchases, like the things I talked about at the beginning: vehicles, homes, sometimes appliances, furniture, electronics, things like that. Consumer loans absolutely have a place in your financial management plan. You just need to use them carefully. So with a consumer loan, the loan contract is going to clearly outline how much you're borrowing and when and how you are expected to repay. You need to be careful to keep your borrowing and your debt under control. It can be way too easy these days to get access to loans. We've got, if you turn on the TV, there's commercials everywhere. On the internet, there's commercials everywhere. There's all kinds of lenders that are out there that are just itching to lend you money. It's not because they're nice and they want to lend you money. It's because they want to charge you interest on what you borrow. So if you borrow more than you can realistically repay, bad things can happen. Major financial issues such as asset repossession. So if you default on, say, a vehicle loan and the repo guy comes and takes your car, that's bad. Foreclosure on real estate, or kind of the ultimate, what you really don't want to happen to you, is bankruptcy. So some characteristics of consumer loans. Most consumer loans tend to be what we call secured installment loans. So with a secured loan, you pledge some asset as collateral on the loan. So for example, if you take out a loan to buy a car, generally that vehicle is going to be your collateral on the loan. Lenders like to make secured loans because it reduces the risk to the lender that you will not repay that loan. Because if you've got that collateral, you take out this loan to buy your car, well, you probably really like your car. You're going to probably try to do whatever you can to make sure you make your payments to keep that car. So it reduces the risk to the lender substantially when you have that loan secured by some asset. With an installment loan, the loan is repaid in installments of principal and interest at some set time interval. A lot of times it's monthly, but depending on the negotiations with your lender, it could be quarterly. In some cases, it could be annual payments. It just depends. Consumer loans can be both fixed or variable interest rate. The majority of consumer loans tend to be fixed interest rates. And again, that goes back to they're easy to budget for. People tend to like those. And your interest rate, if it's fixed, if it's, a mortgage loan for 30 years, well, okay, then my interest rate in year 1 should be the same as my interest rate in year 30. And I can prepare and budget for that so that you don't run into cash flow problems. Loan terms vary considerably. It's usually going to depend on the loan purpose as to what the term of that loan is. So the length that you're going to be. Shorter term loans will require larger periodic payments. However, the shorter your loan term, the less total interest you will repay over the life of that loan, simply because it is a shorter term. Longer term loans will have smaller periodic payments. This is why longer term loans are popular, because the cash flow requirements are easier for people to make, but you are going to pay more total interest the longer the term of your loan. So for example, if you look at like a mortgage, in a lot of cases, a mortgage is either a 15-year mortgage or a 30-year mortgage. If you opt for a 15-year mortgage, your monthly mortgage payment is going to be quite a bit higher, and you've got to make sure that you've budgeted that you can meet those cash flow obligations. However, the shorter that loan term is, 15 years versus 30, you're going to pay a tremendously lower amount of interest on that shorter term loan. If you go for the 30-year mortgage, well, your monthly payments are going to be a lot lower because it's a longer term. But if you add up the interest you're paying and compare to the 15-year loan, you're going to pay a lot more interest on that longer term loan. So something to think about whenever you're starting to think about things like that. But just keep in mind, the shorter the loan term that you can secure, the less interest you will pay over the life of that loan, which is always a nice thing. Installment loans are set up so that the loan is going to be fully repaid at a predetermined date. So with an installment loan, you know exactly when that loan is paid in full, and that's nice. And again, from a budgeting standpoint, it's nice to know that. And it just varies. Again, the length of that loan payment term is going to depend on basically what you're taking that loan out to finance. Each loan payment is a combination of principal and interest. These are called amortized loans. The early payments that you're making, if you sit down, and it's actually pretty easy to do mathematically, you can sit down and actually calculate how much of each payment that you're making is interest and how much is principal. And with an amortized loan like this, that amount changes with each payment. So in the early periods of paying that loan off, what you might find is that a lot of those loan payments, a big chunk of that, may be going toward interest with just a kind of a small amount of principal that's being paid off. But as you go through time and you pay more and more and more of that loan off, you're paying off your principal. As you pay off your principal, there is less interest, as you pay off your principal, there's less principal there to accrue interest on. So what happens is over time, your payment stays the same, but the amount of principal within that payment is going up and the amount of interest that you're paying is going down. So it's pretty interesting to sit down and look at the structure of that. And like I said, you can actually pretty easily make yourself a spreadsheet of each payment you would be making whenever you're repaying that loan, and how much of that payment is principal and how much of that payment is interest. Some loans do enforce a prepayment penalty if you pay them off early. So this is something, if you have a pretty good idea that you're going to want to try to pay a loan off early, before you ever sign on the dotted line, you need to talk to your lender and explain that and say, hey, I think I may want to pay this loan off early. Are there any penalties if I do that? And what these penalties do is, in some cases, that penalty would essentially be all the rest of the interest that you didn't pay because you paid it off early. So make sure you understand your loan terms before you finalize a loan agreement. Don't be afraid to ask questions. That is what the lender is there for, is to answer your questions. And if you're not comfortable with something, don't sign off on it. Make sure that you've done your homework and you're educated before you jump into something that is not going to be good for you. So the interest rate and your loan term, so the length of the loan, are both going to determine how much you ultimately repay on the loan. Obviously, you're going to repay the principal that you borrowed, but your interest rate and the length of that loan determine how much interest you end up paying. So in general, to try to get the best interest rate possible you can on a loan, first, it helps to have a good credit score. Okay, there's a lot of things you can do to try to improve your credit score. One of the best things you can do is to pay your debt payments on time and pay in full. And if you can, maybe pay even a little extra. That's a really good way to increase your credit score, is by paying a little extra each month on those loans. And then aim to be the lowest credit risk customer you can for your lender. And by that, what I mean is, first, get the shortest term loan you can afford to repay. As I mentioned just a minute ago, this will reduce the interest you pay. But the shorter the loan term, the more assurance to the lender that you're probably going to be able to repay it. So in other words, if you've got a 3-year loan on a car versus a 7-year loan on a car, there's probably less likelihood that you would have some major catastrophe occur in 3 years that would prevent you from repaying that loan than if you were to have a major catastrophe within 7 years. So the shorter the loan term, the more assurance that that lender has that you would be able to repay. Also, pledge collateral. So this goes back to that secured loan characteristic that lenders like. If you've got some collateral, your car or your house or whatever it is, that you've got a pretty good reason to keep making your payments on that loan, that reduces a lot of risk to your lender. Finally, make the largest down payment that you can. And this especially goes for houses and real estate. The larger your down payment, one, the less you have to finance, which means the less interest you'll pay on that loan. But two, the larger the down payment you make, the more that kind of assures your lender that you're serious about this. If you put down 20% on a house as opposed to, say, 5%, then you've got a lot more vested in that asset. That gives a lot of assurance to your lender. You're going to really try hard to make sure you can fulfill that loan obligation. So the lower the risk you are to your lender, ultimately the better interest rate you can get on a loan. Don't be afraid to comparison shop to find the best interest rates out there. There's a lot of different comparison tools you can use these days. And then if you find a lender that you are pretty sure you want to go with that lender, you can absolutely negotiate interest rates as well. So don't be afraid to haggle with your lender and explain, here's my circumstances, I'm expecting to get a raise or whatnot or something like that in the future, and use that to your advantage to be able to negotiate a little bit lower interest rate. So I'm going to kind of wrap up here with the question of, should you borrow or should you save? So borrowing will cost more than paying cash. It's just a fact of life, and that's because of your interest charges. When you borrow, you're going to get charged interest. Do not, absolutely do not borrow money simply so you can go out and spend more. That is often referred to as borrowing yourself rich. That will just create a cycle of debt that can be almost impossible to get out of. Do not borrow just to go spend more. Do your homework. And borrowing is not a bad thing. Many people, for a lot of life circumstances, they're going to have to borrow some money at some point. If the benefits of borrowing outweigh the costs, it's perfectly fine to borrow money. Just make sure you've planned for it and that you don't bite off more than you can chew, and you can make your payments as you need to. But always keep in the back of your mind, cash purchases will always, always, always be less expensive than borrowing, because when you pay in cash, it's yours. You're not paying any interest on anything. It's yours right then. So if you can take the time to save up and make a cash purchase, do that, as opposed to borrowing now just to satiate your want. And then try to pay in cash when it's possible, but don't pay in cash to the jeopardy of your emergency fund. So in other words, don't dip into your emergency fund to go buy yourself a new TV. So maybe, leave your emergency fund where it is, save up a little extra on the side to go buy that new TV. So to control your borrowing behavior, incorporate some planned borrowing into your budget. And there's actually a lot packed into this statement right here. First, that implies you have to have a budget. and you have to have a realistic budget that you stick to. Then do your homework before you just go out and say, I'm going to go buy a new car today. Do some planning. Incorporate planned borrowing into your budget. So do your homework, do some research, figure out what kind of car do you want to buy? How much can you afford to pay? How much can you afford to pay on a monthly basis if you're going to finance it? Plan out your borrowing and then put that into your budget to make sure that your cash flows can meet what you've planned out. Then understand your loan terms and how your interest charges are calculated and repaid. So like I said before, reading the fine print on loans and credit cards is far from exciting, but you need to understand that stuff. The best defense you have when you go into any kind of a borrowing situation is to be educated. You need to be able to have an intelligent conversation with a lender to make sure you're not being taken advantage of. And then and the hard part is set and enforce borrowing limits. So have some amount of debt that you are comfortable taking on and do not let yourself go above that. It's harder to enforce that than you might think sometimes. And then finally, do financial troubleshooting. And so watch out for financial warning signs. So this would be things like, do you have an insufficient emergency fund or do you have no emergency fund? Do you have insufficient savings? Do you not have any savings at all? That is a pretty major warning sign that you need to do some financial management. If you find that you are carrying credit card debt or only making your minimum monthly credit card payments, that is a major red flag that you are potentially headed down a path that you don't want to head down. So try to get that under control because especially with credit card debt, that can spiral out of control really quickly. And then it sounds a little bit silly to say, but a really prevalent financial warning sign is if you are afraid to make a budget or afraid to stick to a budget. And the reason that it seems a little bit silly, but it's really not, is if you know you're not managing your finances very well, one of the hardest things in the world to do is to actually make yourself make a budget and then hold yourself to it and stick to it. So if you find you're afraid to do that, that's probably a pretty good sign that you need to do some overhaul on your financial management strategies. So to kind of wrap up here, on the saving side of things, there are a lot of reasons to save and save early and save often. Pay yourself first so that you don't have to worry about not having any leftovers there. You need an emergency fund. That's one of these things that especially 2020 has shown us it's not really an option. You need to have an emergency fund. So that needs to be probably priority number one when it comes to saving. Successful saving is a result of good planning. Saving does not happen by accident. If you don't plan to do it, if you don't pay yourself first, it's going to be really hard to save much of anything. On the credit and debt management side of things, keep in mind that credit's convenient, but you have to exercise a lot of self-control to make sure that it doesn't get out of control. Determine your wants versus your needs. So before you buy something, just stop and ask yourself, do you need to borrow for something right now today? Or can you save up for something that you want and just pay cash in the future? So differentiate between want versus need. Sometimes it's a need. Sometimes it is. You need it right now, and so you may need to borrow for it. But a lot of times, something we think we need is really something we want. If we would just save for a little bit, we could pay in cash and not have to worry about financing it. Be an educated borrower and fully understand all the aspects of borrowing before you borrow, before you sign on the dotted line. So that includes things like interest rates, loan terms, your repayment schedule, prepayment provisions. There's a lot of other things. Don't be afraid to ask your lender to clarify something. Don't sign something if you don't understand it. And then finally, keep an eye out for your financial warning behaviors. If you find yourself kind of getting into financial difficulty, that's a point where, stop and assess that and figure out what you need to do to kind of get back on track before it gets to be too big of a problem. So with that, do we have any questions?
Kelly, we did have a question come through earlier. When should someone think about getting a financial advisor, and how do they get started with one to kind of help them make some of these decisions?
Okay, that is a great question. So my answer to that would be as early as possible. A lot of times people, especially if you get right out of college and you've got a lot of things coming at you, new job, 401ks, all this kind of stuff, all of a sudden insurance, you're thinking about buying houses and cars, stuff like that. It's overwhelming, but that is exactly the kind of thing that a financial advisor is there to help you with. So and there's not really a hard or fast rule for that. I would say as early as possible when you can afford it. I would start working with a financial advisor because they are going to be able to help you for a lot of those longer term saving needs. So things like retirement, investment, children's education, buying a house. If you're buying a house, paying a house off early and things like that. So as early as you can. That's a lot of times people think financial advisors are reserved for either really wealthy people, they're not, or for older people. That's not the case at all. What you want is to work with a financial advisor in your early working years so that you can be that person when you hit retirement, that you are the wealthy person that has benefited from the advice of the financial advisor over all those years. So I would say as early as possible to start working with a financial planner.